Welcome back to ZBCN Today. The reason ZBCN struggles so intensely with price appreciation starts with one of the simplest but most brutally misunderstood realities in crypto economics. Supply matters more than almost anything else. Institutions don't look at price, they look at how much capital it takes to move an asset. If you inject $1 billion into a low-supply asset like Solana, which has a circulating supply around 445 million tokens, the price moves by over $80. But if you deploy that same $1 billion into a bloated, oversized supply like ZBCN with 90-plus billion circulating tokens, the price barely moves a cent. This is exactly why institutional capital always gravitates towards scarcity assets. The same money creates exponentially larger price movement when the supply base is tight, predictable, and resistant to dilution. In the case of ZBCN, the supply isn't just loose. It's explosive, inflated, and historically mishandled in ways that created lasting damage to token psychology and institutional appetite. And to really understand how ZBCN ended up in this mess, you have to go back to the origins of ZBCN on Solana and the decision that set off a chain reaction: the token split executed in 2023. Everything shared in this video is for educational and informational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Originally, Zebec ran with a 10 billion max supply under the ZBC ticker. That was already a large supply, but manageable enough for institutions to build positions without distorting the entire market. But when the team introduced the converting each ZBC into 10 ZBCN, everything ballooned instantly. Overnight, maximum supply jumped from 10 billion to 100 billion. Circulating supply skyrocketed, scarcity evaporated, and because the business fundamentals hadn't changed, revenue didn't expand tenfold, partnerships didn't increase tenfold, user base didn't multiply tenfold, the only thing that truly changed was the psychological barrier preventing price appreciation. Now, the token wasn't just plentiful, it was essentially seen as infinite by retail investors who don't understand market cap. And while retail loves seeing a token cheap, institutions absolutely hate it, because cheap price plus gigantic supply equals extraordinary capital requirements to move price in any meaningful direction. For retail, 0.003 looks like a bargain. They see thousands or millions of tokens for a few dollars and start imagining magical scenarios like, if it hits $1, I'll be rich. But that fantasy ignores market cap logic. At $1, ZBCN would sit at a $100 billion fully diluted valuation, something larger than nearly every major crypto aside from BTC, ETH, and occasionally USDT. So the cheapness is an illusion produced by irresponsible supply mechanics, not by undervaluation. When we add token unlock schedules, the situation becomes even more fragile. According to publicly available vesting data from CoinMarketCap, November 2025 alone unlocks 1.04 billion tokens. That's a 1.1% increase in supply in a single month, added to a circulating pool already exceeding 95 billion. Meanwhile, market cap hovers around $275 million. A project simply can't absorb supply expansions of this scale without proportional increases in demand, and demand never increases in perfect synchronization with unlocks. So price inevitably feels downward pressure. Even when Zebec announces partnerships, launches new products, or reaches compliance milestones, the positive momentum dies almost immediately because each demand spike is swallowed by fresh supply. This is the core flaw. Token unlocks dilute faster than bullish catalysts can grow demand. Supply expands like a balloon that never stops inflating, while demand grows like a slow, steady drip that can't keep up. Basic economics guarantees the outcome. If supply rises faster than demand, price must adjust downward to maintain market equilibrium. Many people point to Zebec's burn mechanism as a potential long-term fix, but the numbers expose how ineffective it currently is. Zebec burns 1 ZBCN token per transaction, no matter the transaction size. On $300 million annual transaction volume, assuming an average transaction size of $1,000, that equals 300,000 transactions per year, meaning 300,000 tokens burned. That is 0.0003% of the supply. At this burn rate, reducing supply by even 5% would take thousands of years. Burns exist, but they are financially meaningless, and markets treat them accordingly. Compare this to projects like Ethereum, burned millions of ETH, roughly 3% of its supply, or Binance Coin, which has burned over 25% of its total supply through quarterly profit burns, or even meme tokens like SHIB, which, despite insane circulating numbers, have managed to burn over 1% of supply, creating real psychological support and community trust. These projects all share something Zebec lacks: aggressive, meaningful supply reduction at a scale large enough to shift fundamentals. One of the clearest examples of this issue is the May 2025 buyback. Zebec repurchased 50 million tokens, costing $50,000. That buyback triggered a 30% short-term price spike as retail interpreted it as a bullish signal. But 50 million tokens is only 0.053% of circulating supply. Removing such a tiny fraction cannot produce lasting price appreciation, so the price spike quickly reversed. Without structural changes to supply mechanics, every pump fades. If Zebec repeated the 50 million token buyback every month, that would remove 600 million tokens annually, still only 0.63% of supply. Better than transaction burns, but nowhere near enough. To shift economics, Zebec would need to remove between 5 and 10 billion tokens annually, the range needed to create real deflationary pressure. At current prices, removing 10 billion tokens would cost around $10 million per year. This is possible if card revenue grows massively, but it requires a strong, public, long-term commitment to reducing supply, something the project has not demonstrated yet. To understand how other blockchains have fixed supply disasters, you have to look at historical precedent. Ethereum fixed its inflation problem with the transition to proof of stake and the EIP1559 burn mechanism, fundamentally reshaping ETH's supply curve. Binance executed aggressive quarterly burns funded by exchange profits and eliminated a quarter of its circulating supply. Shiba Inu used community-driven burns, Shibarium burns, and ecosystem incentives to meaningfully reduce supply despite massive initial numbers. All successful supply turnarounds share the same pattern: aggressive, sustained supply removal funded by real revenue or core protocol mechanics. Symbolic burns don't work. Tiny buybacks don't work. One-time deflation announcements don't work. Markets respond only to burns large enough to alter long-term supply arithmetic. For Zebec to fix its supply disaster, solutions do exist, but they require strong leadership and strategic courage. One option is implementing quarterly revenue-funded burns similar to Binance. If Zebec generates $10 million in yearly revenue and dedicates 50% to buybacks, they could remove around 1.7 billion tokens per year. That's still modest relative to the massive supply, but it's finally meaningful. Another option is raising transaction fees and burning them entirely. If each transaction burned $1 worth of ZBCN instead of a single token, annual burns could theoretically reach the tens of billions. Though this level of burn is unsustainable long-term, it shows how powerful fee adjustments can be. They could also introduce staking with burn mechanics, requiring users to stake ZBCN for premium features and burning portions of staking revenue. If 30% of supply gets staked, circulating supply shrinks from 95 billion to around 66 billion, immediately improving scarcity. Another option is a reverse split that restores the original 10 billion supply. This doesn't change market cap, but fixes psychological problems instantly. Institutional accumulation becomes easier. The token looks more serious. Scarcity returns. Price per token rises tenfold without any actual market cap change. This is how businesses in traditional finance use reverse splits to fix perception issues, and crypto is no different. They must take risks, commit revenue, potentially upset retail, adjust business models, or accept temporary panic during a reverse split. And most crypto teams avoid these hard decisions. They prioritize user growth, partnership announcements, feature rollouts, and expansions over fixing token economics, because product development feels exciting and glamorous, while supply management feels technical, boring, and punishing. But crypto markets don't care about hype. They care about supply and demand. Bitcoin's product is slow, inefficient, outdated, yet it thrives because supply is strictly capped and halving events reinforce scarcity. Zebec has the opposite problem. Fantastic product, strong utility, real revenue, MasterCard integration, but broken tokenomics. And unless that changes, all growth will be overshadowed by endless dilution. What makes this even more complicated is the psychological and operational barriers preventing implementation. Reverse splits seem like desperation moves to inexperienced retail investors. Leadership fears backlash. Aggressive burns require sacrificing revenue that could be used on salaries, expansion, compliance, or engineering. Raising fees undermines Zebec's entire value proposition of low-cost payments. Staking requires engineering resources that might be directed toward enterprise adoption. And finally, the biggest barrier. Many founders in crypto simply don't understand token economics deeply enough to appreciate how existential supply issues are. They build incredible technology, but overlook the financial architecture required to support healthy price behavior. For Zebec to survive long-term, leadership must publicly acknowledge the supply problem and commit to fixing it. Investors like Coinbase Ventures and Circle Ventures should pressure them, because they have a financial incentive to ensure the token performs well. Communities should demand change because collective pressure works. Analysts should stop hyping partnerships without discussing the 100 billion supply elephant in the room. The truth is harsh but unavoidable. Until Zebec fixes tokenomics, price appreciation will remain nearly impossible. Supply is too large, burns are too small, unlocks are too frequent, and growth alone cannot outrun dilution. If Zebec executed a reverse split restoring 10 billion supply, the current $275 million market cap would price tokens at 0.029, 10 times higher instantly. This is the power of scarcity. It is not magic. Zebec is not hype. It's not vapor. It's not speculation. It's real infrastructure growing underneath the entire financial system. And one day, maybe not today, maybe not tomorrow, but one day the market will wake up, and when it does, you'll want to already be in position. And that wraps up today's breakdown here at ZBCN Today. If you found this video helpful, make sure to like, share, and subscribe. It really helps the channel grow and keeps us bringing you more daily updates on Zebec and the entire Web3 ecosystem. Drop your thoughts in the comments. We'd love to hear your take.